Is it not true that you mortgage folks caused all this problem?
Well, you know, we certainly did, and but I think it's important to understand is that it wasn't just us. It was certainly Wall Street. There was a lot of culprits in this.
Yeah. Well, take us back a bit, if you don't mind, Richard, and give that viewer some idea of the way things were before we had this situation. What did the mortgage business look like when it was more legitimate than it is today?
Absolutely, and I think in some respects we almost might want to jump back 30 or 40 years to the time when you as citizens or we as potential homeowners would go down the street and get the loan from the bank. And the reason I mention that is that at the time what was so significant about that era was that the responsibility around that loan was largely tied to one institution, which meant that bank, that institution made the loan, they serviced the loan, they funded the loan, and if they had to, they foreclosed on the loan. So they truly had the responsibility at every level. Well, with the advent of securitization, which by and large wasn't necessarily a bad thing, it's one of the things that did intelligently help to increase home ownership in this country. It took that responsibility with one institution and it broke it up amongst a whole host of parties. And what it also did is it kind of diluted the responsibility amongst a lot of players. And when we started seeing the growth of securitization, especially in the late 90s, we started seeing a lot of things that happened, and I know my counterpart here is going to talk a little bit more about some of those things, but relative to the lending side, what we saw over the course of the last 5 to 10 years was a process by which the line between what was and what was not acceptable from a risk standpoint slowly started to move. And hopefully as we go through the show we can talk a little bit more about what drove those decisions. It was largely initially driven by the folks on Wall Street, and I think that's one of the important points we need to make, is that what was able to be sold and packaged into a mortgage-backed security and sold as a bond to investors worldwide was ultimately what dictated to what became available to folks here on
You have written a great article which people can get online through the Independent Institute as well, something called Anatomy of a Train Wreck. Sort of dissect that problem for us.
Right. The basic problem, as we just heard, was that loans were being given to people who really couldn't afford to make the payments. And the question is, how is it that they were able to get those loans? Now, the bankers or the mortgage lenders may have been the ones who actually provided the loan, but at one time, as Richard was saying, you didn't get loans like that. And so the question is, what happened that at one time you didn't get loans and all of a sudden those loans became plentiful? And if you take a look, in the early 1990s, the government tried very hard, almost every branch of the government and the Fannie Mae and Freddie Mac, to lower the lending standards. They wanted to increase home ownership. And home ownership, to increase it, it's going to lead to several things. First of all, in order to have more people in homes, you have to somehow change something. Either you can make houses cheaper so they can afford it, or you can give them more money. And those would be expensive for the government to do. So it took a third route to try to increase home ownership. And the route it took was it was going to make it easier for people who normally wouldn't be able to afford a mortgage to get one. And so they started to lower the mortgage lending standards. And so there's a document by the Boston Fed where they're outlining how banks should change their mortgage lending. And they say things like, you don't have to really have verifiable income. You can take a look at whether they've been paying their bills. You can look at sources of income that really aren't stable sources of income. So unemployment insurance, that can be used as income, even though you may not get it for another 3 months, any more than 3 months. They said, do you have a credit history? That's not important necessarily. There are some people in this country who keep their money under their bed. And if so, they don't use credit cards, they don't have banks, they don't really need a credit history. And so you should be flexible. And that was the term they used. They wanted flexible underwriting standards. And the flexible underwriting standard turned into the loans where you don't have to provide any documentation, you don't have to make any down payment, you don't have to really be able to afford it in the normal sense. The low down payment, the 0 or 3% down payment, was probably the main killer there.